to this afternoon's session. Tony Ryan's my name. I'm the Global Head of M&A for Jones Lang LaSalle, which is lots and lots of fun, and that's really what this session is about. Now, this session was originally called Hunter versus Hunted, so I expect you're all you're coming to see a David Attenborough film, but as is the way of the world, this is just the hunters. We don't have any hunted. They flee. And so, in fact, what you have here, it looks a little bit like a school council meeting, doesn't it? You have here, these are the gentlemen who are the top of their food chain. These are the ones who have dominated and won and now are titans of the universe. Now, Rick, you would be what? Maybe American Eagle or something? Yeah, okay. How's that?
I thought it was the 800-pound gorilla.
Right, okay. Or lion, is that more, Okay, lion, okay. Matthew.
Yeah, I'm sorry, but I was hunted a year ago, so I'm not.
I know, now you're hunted. Well, you are very clever. Okay, so you're probably the dragon, right?
Yeah,
That's the highest animal in the mythical food chain, probably. The French. Le coq? No, probably not. Okay. What are you going to feel comfortable with?
In one of your slides, you have a picture of a gorilla.
A gorilla? Oh, I think Rick
Sounds
wants to be
about
the gorilla. Maybe a shark.
Well, shark, it depends. You can have
Right,
a
you know that
combination
French
of
shark and...
Well, that doesn't exist, is it?
Right, okay. Well, we'll find the right animal for you, Nicholas. Everybody, that's our job at the end of the session. We're going to find the right animal for Nicholas. We'll see what he is.
Please.
Okay. So what a fascinating time we've been. 12 months ago, who would have thought we would have had, well, yours was a little bit earlier, your deal, but who would have thought 12 months ago we'd have these sorts of transactions happening? And this is a transaction these transactions are really changing the industry about the way we all do business and what it takes to be a hotel management company in this world. Because before, it was okay. Anybody could manage a hotel, correct? 25 hotels, sure, not a problem. No big deal. Don't need to be big. Size is irrelevant. It's quality of the guests, nice smile, lovely person on the front desk. These guys have changed all of that. Now we're talking about this is a serious business. This is a serious business that requires scale, requires millions of dollars because the threats coming down the pipeline at us are very, very significant. And I think that's what these transactions have been about, and that's what we're going to explore this afternoon. So, David Bowie, we're in Berlin, right? David Bowie, we've got to honour him. So this was it, turn and face the strange, going to have to be a different man. So that's the story. This is now a different industry as a result of what's happened in the last 12 months. So let's talk about Rick, your deal. Marriott Starwood, 5,500 hotels, 1.1 million rooms, 100 countries, 30 leading brands. So take us all through it. Why the hell did you do it?
Well, a number of reasons. Step back for a second. Really, what we've been doing for the last many years is different kinds of deals. The kind of deals that we've specialized in are what we've called bolt-on acquisitions. So those of you who follow the industry know we've been active as an acquirer. We bought AC in Spain. We bought Protea in South Africa. We bought Gaylord in the United States. We bought Delta in Canada. Usually each of those has its own reason for being. Distribution plays for geographies where we weren't located. Maybe a product, in the case of AC, something that was different than what Marriott had in its portfolio. This is a different kind of deal, right? This is a transformative kind of deal. So as those of you who followed it in the press know, and those of you who, I brought my Bible, this is our proxy statement.
So this is a public transaction.
Public deal. So you really can read all about it.
He's got 750 pages.
Right. So this is not something that kind of we're pursuing long term. It was a bit opportunistic, but when we thought about it, it is, as Tony said, kind of transformative. So I'll parrot my CEO. Why did we do it? One, I think scale does matter, and it increasingly matters. We see a lot of competitive threats from non-traditional sources, right? Lots of people are trying to get into our business. Travel has become low-hanging fruit for anybody who has an internet connection and some business acumen. And we look at that and see even bigger threats coming down the pike. We all talk about the OTAs in these conferences all the time, but we don't talk about Google or Apple or some of the other folks who we know are thinking about how to get into the travel space where they think there's money to be made. So strength in size, we think increasingly will be important. So that was a driver, because you don't do something like this unless you want to be the biggest guy in the block. In addition to that, we've always liked what Starwood had. They have great stable of brands. We think, I know some people say, are there too many brands? We never think that's the right question. There are a bunch of great brands. We think we can fit them together. We think we can accelerate the growth. We've been a growth machine. We've had a better percentage growth than Starwood has for the last few years. It's just the way it is. And we see some of these brands as great targets for us to accelerate growth. And then there's, although this isn't really that high on the list, there are synergies to be had. So we have duplicate organizations, and so there's a fair amount. We've publicly announced that we think we can save $200 million plus out of that, and that turns the transaction into a more favorable economic transaction. And then maybe the thing I should have put first that I'm putting last is the loyalty program. So guest loyalty, having that direct connection to the guest, having that guest who trusts you and wants to make that reservation directly with you, and owning that relationship is increasingly important. I think it's what separates the big brands from not the big brands. The loyalty programs are key. They have a great loyalty program, so do we. So somehow putting those two together with 50 million plus loyal guests is something we think will be a great competitive advantage. So those are the primary drivers.
Right.
Economics was not unimportant either, but.
We're going to come to the pricing in a little while, but so we had Starwood, a fabulous company. You were number one. You were, say, 800,000 rooms. They were about number 6, coming in at around 400,000 rooms. So we've merged number 1 and 6 in the community.
Now, before you do, I got to do my commercial. We're a highly fragmented industry with lots of competition. We're still in the regulatory environment. We don't have approval yet for our transaction.
Right, okay.
So 1/6, but in market share, I think together we'll have 14% of the market. So we are probably by far the most fragmented consumer-based industry.
Why don't we?
So I had to get that in.
Why don't we just talk about that,
Yeah.
actually, because that's really interesting. Because let's just look at this. Our industry is fragmented, consolidation ahead. So what if we took as the top 5 companies in each of these industries, and we looked at their market share, and we put all that together. So car rental business, between the top 5, it's nearly 100%. Cruise lines, tobacco, the soft drink industry, even the beer industry, highly consolidated. Where are we coming in? About 20. The top 5 companies in this business only represent about 25% of the total business. So this is a really fragmented industry. Hotel management companies, top to bottom, you run through using STR data for the parent company, you end up in around 290 hotel management companies above 2,500 rooms. There's an awful lot of space to play in here, and that's the consolidation terrain that we're looking at that is coming down the pipe at us. So Rick, yeah, very fragmented industry. Any competition regulator should have no trouble whatsoever with just whacking together a 1.1 million of rooms, correct?
Yep.
Okay, let's go back to Starwood. Starwood, a year ago, that's a fine company. That's not a broken company. Why the hell did they sell?
Well, that's probably a question best put to somebody who's not on the stage, but I can parrot kind of what they've publicly said. I think they saw some of the same things we did, and I think they are a company that was kind of driven to look at shareholder value and thinking about how to unlock that value. They did have a management change in the top, which sometimes facilitates people thinking about the buzzword strategic alternatives. So they lost or separated from their CEO and had an interim CEO. So that does cause people to think a little differently. And then they didn't necessarily decide to sell. They also were looking, I think, again, the proxy statement talks about this, they were looking to potentially buy. I think that one way or another, they wanted to get connected to something that was larger than they were. The part of the business that they have not participated in that much, that is fairly, I think it's fair to say, exploded in the last few years, has been the select service part of the business. They have a couple of select service brands that we like very much, but their growth compared to us or Hilton or Accor has been very little. And so to connect their kind of full service and luxury stuff to the full chain scale, I think it was a powerful opportunity for them.
And do you think the analysts really want you to want lodging companies to be able to take it from luxury, super luxury, all the way down to budget?
Oh, I don't think analysts focus necessarily on that issue. I think that's more something we think of for the consumer, We like to capture the customer and graduate with them as they hopefully excel in their own lives and can afford a bigger price point. I think analysts are more focused on a variety of issues relating to stock performance and return of capital and issues that aren't necessarily whether you have brand change. I think if you're a dedicated economy brand that has really high return on invested capital and just powers through money and returns it to your shareholders, you'll have your set of analysts that think you're doing great. So, does Choice Hotels have to do something other than do what they do? I don't know. They have a higher multiple than we do right now. So.
Right. Okay. So just on multiples, let's touch on that. So can we talk about a pre-synergy multiple, sort of EBITDA multiple? I know it's a public company and they're taking shares, but roughly, what's just some sort of...
Are you still with me? We're going to get these other guys in here in a second.
We've got a couple more questions for you, and then we're going to move on to our French.
Yeah, so public information. When we announced the deal, we were paying, again, stock deal, so almost entirely stock for stock, so the multiple varies with the stock price. At the time we announced, we were paying roughly in the mid-12s, and post-synergies, that would have translated to the mid-10s. Our historic multiple between 12 and 13 on a forward. These are all one-year forward multiples.
Okay, so if you own a management company, take note, right? So 10, 12, although our French friends paid a little more.
Yeah, it was slightly more than that.
Right, and we're going to come why that was such a smart idea. Okay, Rick, you were talking size. Size matters. We looked how unconsolidated this industry is. Google, we talk about Google and Apple potentially entering this market. Now, the capitalization of Google is bigger than all the major hotel companies put together.
Yeah.
So we're dealing with a hell of a monster there. Are we, you all got bigger now, but I'm just wondering, I'm not too sure if you really are that ferocious eagle that we're talking about. Maybe you're more just like a little bird.
No,
when you consider the size of Google.
So here's the perspective. Again, these guys should speak up too, but as long as the way they want to enter the business is not to deliver the room, then everybody here is highly relevant, right? Google wants to be an asset-light company as well. So the question I think all those guys have is how to get into the intermediary game and capture a piece of travel, which is a profitable business that people have gotten into with relatively low capital investment initially, high marketing investment, but low capital investment. How can they capture that without having to build hotels? So as long as they're not going to build hotels and own hotels, distinguish them from our friends at Airbnb, different business model. As long as that's their business model, they need the guys who own the hotels. And we as an industry have never rejected intermediaries. We have travel agents since we started. The question is, who owns the customer, who controls the pricing, who does the things that we need to do. And so that's where I think our size, having the best set of hotels, becomes highly relevant to whoever wants to enter the space, no matter how big their market is.
And it's not just about real estate, it's also very much about service and about, product differentiation, the kind of, innovation or the kind of experience that you're providing to your guests. So I guess that also very much something that we are in control
Well, let's come back to the story about owning the guests in a minute. But so, Nicholas, you're with Accor, and you were very involved in this transaction, Accor and Fairmont, Raffles. So there we go. So there was 12 Raffles hotels, 70 Fairmonts, 32 Swiss hotels, 400 hotels in the pipeline.
Yeah, I mean,
So let's tell us about how did that happen? What were the Accor board? Why did they come to this decision?
Well, I guess it relates to many of the factors which Rick just mentioned, but certainly for us, what makes Fairmont a great addition to our existing portfolio is certainly the brands that we are acquiring. It's no mistake that we were certainly filling a gap with that transaction on the luxury end.
On the luxury end. So this helped cement you for luxury. Let's come back to that. You've got a huge luxury stable now, Rick.
Yep.
Wow. So I thought we never made any money out of luxury, but you're all running at luxury hotels, huh? Yep. So you wanted to do luxury?
Yeah, I mean, certainly, and of course you need to, make a difference between being an asset-light operator and being a real estate operator, a real estate owner. And of course, I mean, you've seen a number of transactions, even in the real estate space, in the luxury segment. Yeah. And it seems that this is a highly attractive segment, not just for hotel operators, but also very much for real estate guys.
Right, okay. So Fairmont brand fills out your luxury. Geographically, there's a lot more dots on the world as a result of the deal?
Geographically, of course, we were present in the US with Sofitel, but we were certainly lacking a presence. And I guess the fact that we...
It was a very well-known Sofitel, though, wasn't it?
Well...
let's put that behind.
No, but I guess in the end,
Right.
we acquired also a very much famous hotel in New York.
Oh, famous because of...
No, for different reasons, but certainly also very much well-known in the industry. And I guess the name, the Plaza, speaks for itself as well.
Right.
And not just for the reasons which you were hinting at, right?
I was just being naughty about a famous incident that happened in one of your hotels. Okay, so now you've got a lot more dots. You've got Swiss Hotel right across North America now. Gives you great presence.
Yeah, I mean, with the Fairmont brand, certainly we acquired a portfolio of locations in the US, which are very hard to replicate.
Yeah.
I guess certainly for us, it's not as big as the presence of Starwood in the US, but it was also a way for us to secure locations in very difficult sites. And actually being present in most of the top 25 markets in the US is something which is...
And the US has been a struggle for you over the years. I mean, I mean, Sebastian, your CEO at NYU conference, so those who were there just last year, was talking about how good Accor was, and someone popped up the audience and said, yeah, well, how's the US going for you? And he said, problem, I will fix it. So, man of his word, right?
So I guess he's a man of his word, right?
Yes, absolutely. Yeah.
No, but certainly, I mean, at Fairmont, and generally speaking, the issue that you were discussing is something that we have very much been focused on over the last probably 24 months, or at least since Sebastian joined the company. And we've been, of course, monitoring the situation around various companies. And but certainly beyond that, I mean, I've been in this position for at least 8 years, and Fairmont was very much at the top of the list of the potential targets. And for us, it was a great fit, both geographically, in terms of brand, and also in terms of people, which is probably at the end of the day the most important factor.
You needed the people on the ground to help you deliver that in terms of the US. Now, about the customer and the intermediaries, what you bought an intermediary, didn't you, a couple of years ago? Fast Booking, is that the?
Yep. So we bought it a year ago.
A year ago, and that's a booking platform. It was primarily used by Accor hotels, but other hotels. So you actually stepped into the space of an intermediary buying that company, huh?
Not exactly, because that's just a way for us. And initially, just to be precise, Fast Booking was not an OTA, and it's still not.
Right, okay.
It was actually a digital service platform, so providing digital services to independent hotels. As a matter of fact, we used that platform indeed to expand into the space where we could allow these independent hotels to be distributed through accorhotel.com, so main websites. But it's also, generally speaking, a way for us to probably have a tighter connection to all these new independent hotels which have been filling some of the gaps in terms of product, in terms of locations, and making sure that we could actually make them benefit from the best of both worlds, so to speak.
So we're talking about an Accor proprietary platform, distribution platform, being made available to non-Accor hotels.
That's correct.
Wow, okay. Wow. Is that driving revenue for you? Good business?
It does, and most importantly, it drives demand, and it drives customers' experience and data.
Right, and ultimately, I suppose the idea is that independent hotel might ultimately migrate across to consider itself.
It's totally up to them.
Up to them. Okay.
But again, this is certainly connected to what Rick just said about the importance of people which have been relatively new in this industry, but which are pretty good, such as Google, all the likes. Not just the OTAs, but certainly people which are
right. Okay. Right. Good. Now let's talk about what you did in China. So with China Lodging, wow, one hell of a deal, huh? So what you did, you gave up your Ibis Mercure and Novotel brands in China to a master franchisee?
Well, not exactly, actually.
Okay, good.
But, I mean, part of our mid-scale brand, as a matter of fact, Mercure, in the end, and certainly our economy brands, Ibis and Ibis Styles.
Yep. Okay.
And the whole idea was pretty simple. We, I mean, of course, been present in China for probably 30 years or so. And we've tried to expand in the economy space probably in the last 10 years. And
you've built your own hotels there, haven't you? You've been hotels?
We invested a lot, and actually turned out to be a pretty good real estate investment. But certainly, in terms of speed of growth, we are not capable of, keeping pace with the Chinese local players.
Right.
And in the end, rather than compete them and not be relevant in that market, we preferred certainly to make sure that we could team up with one of them, which we felt we had a great connection with in terms of product, in terms of culture, and in terms of course on objectives over the long term.
And that's the Huazhu China Lodging Group. How many hotels did they have in China already before you did your deal?
That's close to 3,000.
3,000, that's right, yeah. I thought about it. So they already had 3,000 hotels. So you've teamed up with a player, 3,000 hotels.
And just to mention one figure, just to give you a sense of what we're talking about. We currently, I'm not sure about Marriott, but we have roughly speaking 110 developers across the world, so developing our brands, and they have more than 100 just for China. And just for 2 brands.
Okay, so what you've done is you've taken some of your brands, you've given those brands to this particular player already who's got 3,000. He's going to rebrand some of those hotels, Accor hotels?
Indeed. Some of their existing assets, especially in the mid-scale segment, would be rebranded as Mercure mostly, and some Ibis styles as well.
Right, okay. And then you sold him some of your Ibis hotels, correct?
Correct. We sold them the real estate on probably 20 or 30 assets that we used to own.
Okay, and then you took an equity stake in his company?
Correct, roughly 10% stake.
Okay, so that's a couple. Why would you do that? Let's talk about, maybe we can answer this way. Your loyalty program, you've only been going 6 years for your loyalty, 8 years for your loyalty program, right? Accor was late to enter the loyalty program.
It was launched in 2007 or 2008.
Okay, so relatively new. We've had your Hilton Honors has been around, your loyalty program's been around forever, Rick.
We're not Hilton Honors, but Marriott Rewards.
No, Marriott Rewards, but I mean both you are all,
Marriott Rewards has been around for a long time.
Oh, we can't mention the Hilton word, right?
No, you can't.
Okay, so you had how many in your loyalty program, Accor?
25 members. 25 million
25
members.
million, okay, 25 million. Now, how many have you picked up?
Sorry.
25. How many have you picked up now as a result? Was the loyalty program of the China Lodging Group?
Well, they keep their separate loyalty scheme, but of course we've established some sort of a partnership between the various loyalty schemes. So they have, roughly speaking, 36 million members, and of course that comes in addition to the 3 million members that Fairmont
Fairmont, 3 million. You had 25, 20...
No, in the end, if you combine
all together?
If you combine the 3 loyalty schemes together, we'll probably have, I don't know if it's the largest, but it's certainly one of the largest loyalty schemes.
So what does all those numbers add up to? 60 plus million?
Well, it should be in the range of close to 70 million.
Wow. Yes. So since 2007, a couple of deals altogether, you've ended up with nearly 70 million loyalty club members.
Yeah, well, as you know, the loyalty scheme and number of members has been one of the key drivers of, I guess, the consolidation in the industry as well.
So I'm a Chinese person, about the right height anyway, aren't I? But okay, so I'm staying at my hotel when I travel to some Dalian, some small town. Is going to be an Accor hotel, and then I want to go on a holiday. There's 121 million of us went on holidays last year. So I suppose the idea, I've already got a familiarity with Accor, and then when I go offshore...
Yeah, that's the whole idea, exactly. Right. And of course, making sure that we can, in terms of distribution and in terms of visibility of the brands and of course customers' experience as well, we can provide something which is consistent and which I guess rises the brand awareness on both sides.
Okay, consistent though. Isn't there a problem with franchising? You're going to be sure about your brand quality in China? You happy with that?
No, but of course, and one of the reasons, and probably the key reasons why we chose to partner with China Lodging is that amongst the Chinese players, they are by far the most consistent brand and the most consistent operator.
So you did lots of homework to find out, got the right player there.
Of course. Again, that is something on which we've not discovered the opportunity just like that. We've been following this situation probably for the last 3 years, 3.5.
Now, we can't finish the talk about Accor except your shareholding. So you've got a new shareholder, Prince Al Walid, Kingdom. He's come on the...
whenever we close the transaction, which...
So yeah, 2.9 bill you paid, so 3 bill. Wow, 3 bill, you paid 12.
Yeah, well...
He's got a great deal. You could have done your deal 4 times to the price you could have bought Starwood.
They got 40,000 rooms, we got 350,000.
Oh, right, okay.
And it's all a matter of the brands, I guess, in the end, right?
Okay, I was being naughty. Okay, so you've got your shareholding now, you've got Prince Al Walid, you've got Qataris. They've got how much?
They will have, and again, I would like to stress that the transaction is not closed yet,
no.
But they'll have close to 10%.
It's okay. There's a couple of lawyers in the room, a couple of failed lawyers. But so that now, but you've got a brand new shareholder on your register, correct?
It seems so.
Seems so. In the last couple of weeks, and so now we have Jingjiang, who's taken a stake of 11 point something or other.
Not sure. 11.2, I guess.
11.2. Whoa. Okay. So all of a sudden, you've got the complexion of this company, which used to be a crusty old French company, where is now got a very interesting share register, hasn't it?
We'll
Looks
see.
that way. We'll see. Okay. Well, what's that? Look what's happened to Accor in a couple of years. You know, what a great industry we're in. Okay, Jinjiang. That brings us over to here. Wow. So Jinjiang make a big investment in Louvre Hotels. So, Matthew, can you take us through that particular transaction?
Yes, so as I was saying, a little bit more than a year ago, we were hunted, and now we are hunter.
Right.
I will come back to this because it's more a fisher than a hunter, actually. I will elaborate. But last year, indeed, we started Starwood Capital started a process for disposal of their investment, and with a process starting in June 2014 with the pre-marketing. Process went official on September 14 with a signing with Jinjiang on December 14. So it was a very fast track, and the deal was closed in March 2015, so a little bit, exactly a year ago. So there's been a very interesting process because it attracted a lot of different profiles. Investment funds, private PE, but real estate as well, strategic buyer, competitors as well were looking at us. And finally, the Jinjiang Chinese bought the company and closed the deal in less than 3 months. So it was a very interesting process to attract and also to show how what we have delivered in the past 9 years with Starwood Capital, and basically creating a platform for Chinese investment and Chinese aspect of the tourism. That's one of the reasons they were keen on buying us at the first stage, even though we were not on the top 10 of the list of potential targets. But as you can notice, it's been the beginning of the new story of Chinese going outside China, and Jinjiang with being one of the most active player in buying hospitality and tourism businesses outside China.
So let's just talk about, just so people understand, your China business already. Let's just, Jinjiang in China, you know, Shanghai last week, Jinjiang in here. You own the Peace Hotel, obviously.
So first of all, Jinjiang itself is a SOE, so a state-owned enterprise owned by the Shanghai government. So it's a municipality-owned company, active in hotels. So they own and operate 2,000 hotels in China. Right. They are also active in travel market because they own the largest travel agency, Jinjiang Travel. They also own car leasing and car rental businesses. They have also the F&B, KFC master franchise, and so on. And they are active in real estate, capital market as well. So
a big player.
Through this, they have a controlling stake in different listed companies. One of which bought Louvre Hotels. So basically, our direct shareholder is a private Luxembourg company. On top is a listed company in Hong Kong, and in the end is a SOE. So we have the public company with the political guidance. We have the capital market constraints, and finally we are privately owned in Europe. So we have all the way up the different categories of governance that we need to manage.
Okay, so are we looking at potentially vertical integration here, where the customer wakes up in the morning, decides that they might want to travel somewhere, they go onto your travel agency website, you then, I book. Do you have an insurance company as well as part of your business?
No.
Okay. So, but then currency, do you have currency? Do you have currency business?
No.
HNA is a currency. Okay, then I get on
I guess Chinese are dealing currency.
Right, okay.
Hedging anyways.
So then I then travel, I go to the airport, jump on a plane, and go off to stay at a Jinjiang hotel, Jinjiang-owned hotel. You've got transport services and tour services in the country. That's going to be part of the plan as well, is it?
Well, okay, let's say there is a political governance behind this move of Jinjiang to Louvre Hotels and the travel business. One of it is basically how to bring brand and know-how to the Chinese market in order to create domestic value. You know, Chinese for goodies, clothes and everything has been copying and being the producer of the Western brands. And one of the key elements of Chinese politics is to bring the know-how of how to create brand management and so on for the domestic market. Right. So that's one of the reasons. And we are spending time with the different directors of different verticals and departments traveling to China and give lectures and presentation to a lot of staff in the different verticals of Xinjiang. So one of the key elements of this acquisition is really to bring know-how of how to manage brand and businesses
so there's an IP
in China.
Transfer back into
That's
China.
one of the main political moves. The second one is obviously they see the Chinese outbound market growing a lot. So they want not only to participate in the travel agency business whereby they send the people out and then they wait, they come back. They also want to be in the reception of the Chinese people traveling out. So they want also to participate in this being the inbound reception of the Chinese going out. And so it's really key to have this vertical to manage from the travel agency to airline to hotel, and also, of course, what gather all that is the customer relationship. We are talking about loyalty program becoming more a customer relationship business. So that's the key factors.
Some of the interesting numbers about the actual spend from Chinese outbound is, so if you look at the total spend, let's just say it's $1,000, it's roughly $500 is spent on accommodation and transport. And the other $500, you know what it's spent on? Shopping. So we should get in the retail business, right? If we're going to pick up that traveller, that'd be the plan, wouldn't it?
Let's say, again, part of the political aspect is also to diversify their investment in Europe into other verticals. One of which is basically the travel business also outside China, but also the retail, elderly housing management and so on. Right,
okay. Rick, maybe you're about to buy Nordstrom's or Saks on Fifth Avenue?
Pure play lodging management business.
Right, okay. Now, I've skipped over you and your China strategy, Rick. To be fair, you just made an announcement 2 weeks ago in relation to some planned rollout.
I think something both these guys said in China, and we're not really talking about M&A here, but in China, in the space that is above economy, we don't really participate in the economy space, but mid-tier space. I think it's become pretty clear no Western player is going to go in there and develop the 1,000 hotels that you need on your own. So everybody's looking for the right partnerships, and it's a challenge because you've got to protect your IP. You mentioned IP transfer, and it's something that dealing with the Chinese you have to be careful about. We want to protect our IP everywhere. So we have spent several years kind of looking for the right partnership to take one of our brands. So we announced Fairfield Inn. We have a partnership with Great Eastern, which is also has lots of hotels, but is not one of the 3 or 4 largest. They're in the many hundreds of hotels as opposed to the few thousand.
It's pretty big already.
Yeah. So I think that all of the companies, I think Hilton has announced their partnership
with Patino,
Yeah, so everybody has tried to find the right partner to help them more rapidly distribute. The other thing that happened in China is it was for a long time and remains a heavily leased model for the hotel, and leasing in a way that Western public companies are probably not all that comfortable with in terms of the security of tenure and what that lease looks like and whether the lease is appropriate for the building you're in. So to have local partners who deal with all that and to deliver the brand, and a lot of it is to get that customer familiarity that you're looking for the outbound travel as well, to get those people in your program. So we've announced our partnership.
Terrific. Okay. So just as the back, we do have some seats up the front here, next to this very good-looking gentleman, Eric Levy, if you want to come up the front. Okay, now we've got our dragon over here. So in the last couple of weeks, dragon's letting loose, and Lecoq, I think you're in trouble, right? So what's our dragon? What are you doing? What are you doing with our French friends over here?
apologize if I have to remain silent
All
about
right, okay.
Well, I guess I'll use the same stance.
Right, okay. So we'll watch and see that. So you can't tell us what you're doing, Dragon, huh? Okay, that's our 3 deals. That's fine. We've looked at our industry fragmentation. Despite what we think and despite how important we all think when we wake up each day, we're actually very fragmented. It's small. There's a whole room for consolidation on this. As I said, 290 management companies. The multiple, let's talk multiples. So 10 to 12 for Rick, if you've got a management company, that's what it's worth. Yours was?
Well, slightly above 12 after synergies.
Yeah, slightly after synergies and before
Yeah.
synergies closer to 20?
Well, in line of comparable transactions.
Okay, close enough to 20. After synergies, down to 12. Good.
20.
And Matthew, was there a...
So Jigjiang bought Louvre Hotel at 11.
11 multiple.
Yeah.
Okay, good. So everybody who owns a management company, very quickly how much you're worth, right? That's great. Synergy's important, that's to bring it down. Rick, did he overpay?
My view on these, first of all, is payment.
I'm going to ask you what you think of his deal and all of that.
So he told us he was going to do that. So I think when you're paying for size matters, so that I think you can stretch more for a smaller transaction. You make a mistake on a $12 billion transaction, it's hard to recover. So what I would say is I'd look at it strategically first. When we look at all these deals, right? Fairmont was a process that was known in the industry that they were out there. So Marriott looked at it. We're big. We pretty much look at everything. And when I looked at it, I said, to me, there are 2 people who should be more aggressive in this than we would be, Accor and Intercon. Because if I looked at the brand mix and the geographic diversity, and I wanted to fill out their portfolio, if I decided I wanted to be kind of top to bottom, they have a nice French branded Sofitel, but it's not widely distributed. It doesn't have North America. So when I look at Fairmont and Swiss and Raffles I think is a jewel. They only have about 8 of them. It's got good Asian name, way outsized to its distribution. I would have thought that was a good transaction. Now, they paid a lot. Look at the height of the last market. Somebody took Four Seasons private at 38 times EBITDA. I think the last time Fairmont transacted, it was about 20 times that EBITDA. So 20 times is a high price, but if you can achieve the synergies and if you get the strategic benefit out of it and you can grow into it, and growth has got to be a big part of their strategy, I think strategically it looks like a good, interesting deal.
Good, okay. Good advice for all you budding M&A people. What do you think of his deal?
Well, certainly I would have loved to do that deal.
You would have loved to have done that deal? Wouldn't we all have loved to have done that? I would have loved to have done that deal.
No, but of course, Star Wars, as we all know, has great brands,
Great
and
brands.
certainly a great expertise in some niche markets, and I guess makes a lot of sense for them
Right.
to combine with another large player.
So, Matthew, I think I know your parents' view about the deal was it was pretty good because he's just jumped in 11.2% of the shares, right?
Well, it's not done, so we'll
No. Okay, so that's called voting with your feet.
The other thing I'd say about when you ask if somebody overpaid, neither of us paid with cash. We paid with stock.
Yeah,
now,
exactly. I was
there's
about
good
to
and
say,
bad about paying with stock. From my point of view, stock is pretty expensive in terms of dilution of shareholder earnings, right? We get a bigger EPS hit with stock than you do with debt at its current prices, right? We can, if you're using an appropriate level of debt, we can borrow at a very efficient rate. But the thing about stock is it's all relative to the value. And if you're doing a good transaction and your stock price rises in the time period afterwards, well, then the multiple you paid is really a function of how many shares you issued. And you could be creating tremendous shareholder value even if you pay a high multiple.
Yeah.
So that's the way I look at it. The question for us is, will our combined stock be worth more afterward? Then the multiple really doesn't matter too much because you're not using cash.
Yeah, and you're not just paying for what you get, you're also paying for what you will make out of it.
Sure. Okay. You had a little bit of cash, about 840 million, and yours was cash though, right?
Yeah, I wanted to comment on that. It's a completely different approach because for 2 reasons. One is our move is really offensive, the move of the Chinese. I was listening to you about fighting against OTAs, getting critical size and making synergies. Actually, the Chinese is really a newcomer into the market, so it's not looking really after synergy approach or critical size. It's really to go into a political aspect of the Chinese government approach. So that's one. It's really an offensive move and new money because we are not buying our targets with shares but with cash. So really, it's not about the parity of current trading future trading and target trading, but really a return on cash invested directly. So it's really a complete different approach, and we would never make it a deal like they could do because of the synergy creation we couldn't afford, at least, even though the strategic move could have been right.
Rick, would you have done that deal with cash if they'd insisted on it?
We wouldn't do a $12 billion
deal.
cash deal. I mean, what I said about debt borrowing would not be true if we were
I was going to say the banks must have been furious because you didn't borrow anything.
I think that what you could do, and we're happy with what we did, but you try and optimize your capital strategy, to use the buzzwords,
Right.
And some amount of cash could be helpful. Now, what we'll do, and what we've talked about doing, is the combined companies will be under-levered. When we get it, if you look at optimal leverage. So that gives us the opportunity to borrow and then buy back stock, especially at the current prices. We've talked about Arnie talked publicly about what our buyback strategy is. So that's a way of essentially right-sizing the stock cash mix. You just have to do it after the fact, because you got to close first, get the borrowing, and then go buy the stock. So we'll get the right amount of cash in it through managing our balance sheet and getting the right leverage.
Okay. But the smaller deals, when you bought Protea, for example?
We have never used our stock before. All the smaller deals we use cash.
So your Gaylord deal, your Protea deal?
All cash.
Cash, right, okay. Multiples on those, roughly?
I think each one was announced, and I would say this because you said to the folks in the audience, now you know what your management company is worth. Not quite. Not all management companies are worth the same thing. I think we said in almost each of those deals we paid about 10 times EBITDA. Right. Some of them had no synergy, so when we moved into South Africa, non-public company, much more opaque, you're not going to value them the same way. We liked it a lot. But no synergies. We had no presence in Southern Africa at all. It's an easier deal for somebody like me because you get to walk in and say to everybody, there are no jobs at risk. Everybody's employed. We want you, and you're buying it in part for the platform and the people. But I think roughly 10 times, maybe a little more in each of those deals.
Right. Okay. So let's just have a look. So we've got now, where does this leave us? For those people that aren't the 800-pound gorilla, is what's going to happen to the market? Is it going to get bigger, and the quirky, unusual players are going to be over here doing their stuff? Because is the millennial, like this gentleman here, are you going to want to go to a boring, red and green carpet Marriott hotel, or are you going to want to have something funky and a little bit different? Sorry, not a millennial. Sorry. What do you want to do? Do you want to go to an ordinary sort of hotel that just looks like everything else, or you want something a bit quirky and unusual? You go to the niche? Beach. Oh, no, the beach. No, you didn't say beach. You said the niche. A niche. Okay. So is there still a place for the little people, the quirky, unusual, out of the market? Yep. So those who might have seen Residor this morning bought a small 3-hotel company in Germany here. 14 million for 49% of it. Quirky, unusual. 25 hours, that sort of brand, those in Germany. It's a great hotel. Just wander down the road here and have a look at it at Bikini Mall. Quirky, different. So the issue is you've got these big monsters over here, and is there a place for anybody else over here? What do you think? Nicholas?
There's just no separations between the two of them. Actually, as you know, we took a stake in Mama Shelter about 2 years ago. And again, even the small guys, even the guys that fill in a niche market segments will need the distribution, will need the loyalty scheme. So in the end, there's just no separation or no oppositions between the two guys. It's just that, of course, some are targeting different market segments. And in the end, we're about being big and targeting all the different markets, and especially the ones that are growing, right?
Rick, what are you going to do for something quirky and weird?
Yeah, well, I think that I'd fight the premise of the question, which I always like to do. I think there's both room in our industry for niche players. Look, we're a highly innovative industry. Everybody thinks they can do brands, and some people can do brands. So there's always stuff being launched. I think a lot of them want to incubate and then get bought, but I think
isn't that a good idea?
They'll continue to be small players. I think that the risk is more for the medium size. If you are a company that sells yourself because you have some scale, and you have a couple 100,000 rooms or 100,000 rooms, that's where you need to compete in the scale market and be able to deliver the value that competes with what Hilton and Accor and Marriott and Starwood combination will be able to do. But I reject the idea that because you're big, you can't have a niche product. I mean, we've launched Moxie. Any of you who've been to Moxie in Malpensa, or we'll see the one we're about to open in Munich, and the Moxies that are going to come, that's a funky product. People probably 10 years ago would have said Marriott didn't do it. And at the high end, we launched Edition with Ian Schrager. And if you go to South Beach and you go to that hotel, that's not a boring red carpet Marriott, and there are no boring red carpet Marriott. But I think big companies that are innovative, Starwood being one of them, they started W, which was a great product innovation. We can still supply the product and the scale, but I think that's separate from whether in our industry there's still going to be smaller players. There will. I think there will be forever, because as you said, there's 290 management companies. There's probably more brands than that. I'm sure there are.
Oh, no, each of them times 4.
Yes, and they'll continue to be people. And if how you're selling yourself is uniqueness and a personal touch and something that you deliver that's not based on scale, and you can find another way to deliver the distribution channels in a cost-efficient way, then you'll keep going.
Yeah, okay. So let's talk about those ones in the middle. In fact, there's 95 hotel companies in the world that have between 5 and 15,000 rooms. Those guys are whack it straight in the middle without the distribution platforms and all the rest of it that you have. And you wonder how special and different those companies are. Maybe, is that the area that we're going to see consolidation, do you think? Ideas?
I'll let...
Yeah, I think this is part of the target.
Part of the target. Yeah, that's it.
No, but in the end, it also very much depends on the market segments and on the geographies.
Sure, but they need their point of difference, don't they? But if it's just an ordinary vanilla hotel management company with 8,000 rooms...
Yeah, but I guess you even have some mid-sized companies which are certainly have, differentiations and specific position.
One issue, Tony, is somebody has to want to buy you. So there's not necessarily a buyer for everybody who's out there. So there may be some people who continue to go and they might become less competitive. But I think when you ask if there's going to be consolidation, that's where I would look. I think there'll be consolidation in the larger side of that space. You said 5 to 15. Yeah, I'm thinking of the guys who have 50 to 200. I mean, some people who aren't up on the stage who have known
well, there's
to
about
be
33 of those.
Yeah, those are the ones I would think are going to start dating and maybe get married.
Okay, right. Okay. Now we've got some time for questions, and we're going to run through some of these. So, if anybody think of a question, this is an opportunity. Yes, here we go. You just speak up a little bit because we don't have any mics.
Question from Matthew. Could you attempt to quantify for us directionally what the revenue synergies were for Louvre under Xinjiang ownership?
Revenue synergies.
What percentage of your inventory comes from China now, for example?
The Chinese market is growing at 12%, 20% pace to Europe. Our portion is much higher in the big capital cities, whereby we are capturing most of the demand from Chinese now, in Paris, Berlin, and so on. But our regional hotels do not get much from it.
So you've gone from zero Chinese demand to what percentage of inventory in big cities?
I would say in the 10th. Yeah.
Okay. Any more questions at all? We can run through some of these issues. So let's a little run around here. We've got accelerated global growth. Works for you, Nicholas?
Well, obviously, with the strengths of the Fairmont brands, I mean, Fairmont, Raffles, and Swiss Hotel, we have not just many brands, but certainly very strong brands. And just to give you an example, I mean, Fairmont brand is not that present in Asia, where we have a strong presence. So certainly we are looking at expanding strongly the Fairmont brand.
The Fairmont brand?
Yeah.
Hey, let's talk about growth for a second. So what percentage of hotels do you lose out of the system each year that get debranded? Is that around 3% or something or other you might lose?
A little lower.
A little bit lower, 2%?
1 to 2%. Yeah.
Okay, 1 to 2%. Do you have any idea of that?
Yeah, as far as we're concerned, it's actually even lower than that because we have a strong base of owned and leased hotels for which...
Right, and they love it so much. The last thing they want to do is give up an Accor brand. Right, so we've got, so you lose 1 or 2%.
Yes.
Roughly about the same?
Yeah.
Okay. So therefore, now the market requires me to have a growth of around 4 or 5%. That's what the analysts are saying. They want a 4 or 5% growth on net growth.
Net growth 4 to 5%. That's probably on the high side, I guess.
On the high side?
Should be in the range of 3 to 4%.
Our net growth has been 7 to 8% for the last couple of years, and that's what we've targeted.
Same with us. We have 7%.
7-8%?
Yeah.
Okay, so look, so if I've got to have net growth, let's try and pick a middle number, say 5%, right? So if I've got to get a net growth of 5 and I'm going to lose 2, that means I've got to have a growth of 7. Rick, you've got 1.1 million rooms. You've got to find
Yeah, I mean,
770,000 rooms, right?
Our,
700,000.
our organic pipeline right now is over 200,000. And if you think about, if you chunk the market by continent, obviously we're quite big in the United States. But let's think about Europe, which is tied for the biggest hotel market in the world. We had 60,000 rooms in Europe before the Starwood acquisition. They have 40. So we'll have 100,000 rooms out of 6 million. So we have enormous room to grow in Europe. Asia has similar numbers. Now the growth is different. Europe is a much more conversion market. There aren't as many street corridors. Asia is a much more new build market. Although even in Europe, we're seeing a fair amount of new build, especially in the select service space, where we've got 25 Moxies under construction, mostly in Germany. So there are huge categories where we barely compete in the economy space, and then huge categories where there's tremendous conversion opportunities.
So you're not daunted by the fact that your developers have got to go out every year and find 70,000 new hotel rooms to bring into the system?
Yeah, I am daunted, but I don't.
Someone else's job, huh?
It's Tony Capiano.
Oh, you're the M&A guy. You just do the fancy stuff.
Yeah.
Get the girls.
And every once in a while, he supplement it with a big chunk of rooms through an M&A.
Right, okay, through. So when they're short, they ring up the M&A guy and said, I need 10,000 rooms, Rick. Go get on your bike. Is that how it works?
No, but it's not a bad analogy.
Okay. You get a nice bonus, Rick.
Yeah.
Okay, so so your total portfolio is going to be half to you were about 500,000 rooms, so now you're going to be about 600,000 rooms, yeah?
Slightly less than that because, of course, Fairmont Raffles is roughly 45,000.
Right, okay. So we're going to be 550 rooms. So still at 5%, you got to go.
Yeah, and of course, in addition to that, you need to add up the kind of pipeline that we'll be adding with China Lodging, of course.
The China Lodging will solve that problem.
China, I guess, same with Marriott, has represented a significant part of our global pipeline.
Right, okay. Yes, question?
Just because you mentioned the M&A guys, I mean, by doing all this, how do you ring off the equity players in this? Because becoming larger and larger, the problem from the sort of development agency who's doing the debt side of it, I'm always interested, how do you find the equity players?
The equity players.
Yeah. But now we're talking about operators, they're becoming bigger and bigger. How do we identify them?
Okay, so if I've got to find 70,000 rooms at 200 rooms, that's 350 hotel owners I've got to find. Okay, so how do you find the owners?
I mean, the hotel space has been a very attractive class of real estate, and there's been a lot of new growth, not just from conversions, obviously, but also certainly from new developments. It's just in Asia, that's very much the case. Also in Latin America, in North America, obviously, and also to a large extent on certain market segments, even in Europe. So I guess in the end, the asset class is attractive, meaning that you'll find easily investors, and of course.
You wine and dine them too, don't you? And if you get that Accor card, the owner's Accor card, fantastic. Grab that.
Well, I guess that makes a whole difference.
Yeah, it does. It's great, some lovely hotels in Asia. Okay, let's talk about owners for a moment. We've got these things here: accelerated global growth, cost of distribution. We need to touch on that. Leveraging operator efficiencies, loyalty program. This is all great for operators, but what about the owner? Yeah. Why are we doing all this? What's the owner think about all this? As an owner of a hotel, why should I be so excited about the fact that you've done that?
Well, I guess they will certainly benefit from all what we've discussed, which is the reduced cost of distribution, the strengths of the brand.
Okay, reduced cost of distribution. Yep.
The marketing power, the loyalty scheme, which is also a way to have a loyal customer base, and therefore a cost.
So that should all drive higher revenues, huh? On the loyalty side and the marketing side?
And higher operating margin as well.
Right. But is that going to happen? Are you going to lower your centralised services cost because you've got such a bigger leveraging operating efficiencies, a bigger platform? Does that mean my centralised services fees less?
Most of these costs are actually fixed costs. So in the end, the cost per booking should be indeed reduced down.
Right.
Yeah, I would say, Tony, I mean, we've said publicly, a deal like this won't be successful unless we deliver the synergies not only to our corporate bottom line, but to the owner's bottom line. So we've got targets that we're working on. Obviously, our deal isn't closed yet either. But once it comes out, we'll have to communicate with our owners and franchisees, and we have to deliver synergies both at the revenue level, so increasing rate and occupancy, and at the cost level. I think the easier side of that to see in front of you is the cost side. So if you think about your major costs that you reimburse your operator for, a distribution cost is one of the strong ones. And if we can leverage that cost among a system that's gotten 50% larger, the cost ought to go down. There's usually a time period where you have to bear some pain on the integration and deal with that and find a way with your owners to communicate how that and get an acceptance about how that's going to be done. But over time, and not a very long time, you need to deliver better costs.
So obviously with your loyalty program, you want direct, so the cheapest form of booking, correct? Now, the OTAs, the elephant in the room, which we haven't spoken about, big guys already. If I'm an independent, I'm paying, well, it depends on the part of the world, I'm paying 20% to an OTA, right? That's sometimes it's 23, sometimes it's 17. Is that what people are roughly paying for an independent little hotel having to deal with Expedia? Something like that? Okay. So if I go to you as a big chain, I'm substantially less than that, right?
Yeah, although I'd say we talk about this all the time. For us, we would say to them first, that's the wrong question, because the question is not the cost of dealing with them, it's distribution channel shift.
Right.
Yeah. So the contribution to our hotels from all OTAs together is roughly 6%. So the first thing we're doing is we're delivering enormous contribution through our proprietary channel, which is really inexpensive as a cost of reservation. So we have 35-40% contribution from Marriott.com and 6% contribution from an OTA. So when we're talking to somebody about converting a hotel, we often can say, you can pay our entire fee, which we want to be robust,
so where does it come from?
The savings.
Add those numbers up for me again. You've got 45% through Marriott.com.
First it depends. It depends on the brand.
Yeah,
so a lot of our brands are heavily group, and when you're talking about a big group component, it's not in the mix because they do it individually. But if you're talking about transient, I'd say on the transient part, it's going to be more like 50% is going to come through our .com, and then another percentage through voice. Some people still call on a telephone, and then some through traditional travel agents. But the part of is we think of those OTAs who are trying to take a share of the revenue that we all think as the hotel industry is probably not justified, and that we push back against. That's for us about 6%.
Okay, that's low. I mean, normally independents could be up to 30% OTA, something like that. Question, Kevin.
To any of the panelists, can the combined cost of the loyalty program and cost of distribution be shown in any way that could be qualified to have been less to owners in past M&A?
I didn't catch the less than.
Less than previously as a result?
As a result of this M&A, you're looking for cost of distribution and loyalty program reducing. Right.
Yeah.
Okay.
Is there a real live example?
Well, your loyalty program will be percentage of follow.
Yeah, so
right?
I can speak for us, and then I'll turn it over.
Yeah.
So I think we can demonstrate and do that we have driven down the distribution cost, the reservations channel, practically every year for the last the 10 years I've been doing M&A. Now, I can't say it's directly because of M&A, but it's certainly because of growth. So we have driven that down. On the loyalty program, I think as Tony said, it's not our goal necessarily to drive it down, but to make it better. Yeah. To make it better contribution, to make the experience better, to offer more to the consumers. So we're very conscious with our owners of what that cost for a program stay is when somebody's earning points at your hotel. But I don't think we've suggested that scale will drive that cost down. It should make the program better and more competitive to drive more people to your hotel who come through a direct channel, right? Yeah. You only get those points when you book direct.
Yeah, you certainly need to look at loyalty in a different way than the distribution, because loyalty is really to make sure that you create a captive and long-term client base to your hotel, especially in the wake of volatile markets or changing trends in the industry.
But if the loyalty program
again, ultimately, and we see that, I guess, in many of our hotels, not just the cost of acquisition of the client is lower, but also you need to take into account that at least as far as our hotel are concerned, a loyalty card member spends on average 20% more, well, 15% more than the non-loyalty card members. So in terms of revenue, also the customers tend to spend more in the hotels, and most importantly in F&B, for instance.
Well, and to answer your question, the realization of that loyalty, the revenue goes entirely to the owner. I mean, we don't get any revenue. All of the revenue of our loyalty program is generated by people staying at hotels, and 100% of that revenue, other than what they reimburse us for and pay us a fee, belongs to the hotel. So if somebody else were paying for the development of that program, where would they get their return?
We're just about out of time. Any last quick question? Yep.
Yeah, I was just wondering about this whole brand issue. I remember when Marriott was a brand with a single type of hotel, and the same for Hilton, the same for all the other big boys, and then gradually they started to add a few differentiated brands. But we're now at a point, I think, and have been for a while, where you've got so many different brands that the consumer is losing clarity as to what's what. I'm a hotel professional, and I can't remember what all the different brands are and what they all represent and where they fit and how you map them. Now you've just joined, both of you have just joined these big groups. What are you planning to do with these different brands, and how are you going to make sure the client understands what you've got to offer and what's so special about each of them?
So many brands, and what we're all talking about is connection, ownership of the customer, loyalty to the customer, and he can't make sense of this spaghetti. Is that the problem? Response, guys?
Well, I guess as far as we're concerned, we only acquired 3 brands, and they certainly fit very well with our existing portfolio. So I guess there is a clear differentiation and a clear add-on to what our our existing brands are. So I guess it's more a question to Rick.
Rick, you got 30 of them.
Yeah, well, I'd say there's a lot of undistinguished, undifferentiated brands, just not ours, right? So,
He's got 30 Cracker Jack brands.
It's a good question. Obviously, we're not quite doubling our portfolio of brands. I think there's certainly brands that question kind of wouldn't apply to, right? I mean, you can understand the difference between a Ritz-Carlton and a Courtyard. And a lot of our brands are in a stack that goes from high to low. Where you get the challenge and where we have work to do is we have multiple brands kind of in the same tier, and whether you can find a product differentiation for that brand that matters. I'd give you an example that we got asked about, and I think that's been very successful. So when we bought AC, and people knew it in Spain, they said, well, how are you going to distinguish that from Courtyard? Because it is about the same price point. And I think if you think about other products, take cars, for example, price point isn't the only distinguishing feature. That product is entirely different than a Courtyard. If you go stay at an AC in Spain or Italy, or now the rash of them that we're developing in the United States, you can tell it's a different product, even though the price point may be, $120 for a Courtyard and $120 for an AC. And if you look at it from our developer colleagues' point of view, the owner point of view, we've proved it out by when we introduced that product in the United States, where we have 900 Courtyards, I think, roughly. The owners loved it, and we've now got 100 ACs under development because they said, that's a different product. I don't have that product in my portfolio that's going to appeal to a more millennial customer, more European design. I mean, everything from the size of the furniture in that hotel to the style of the common area is very different. So I agree with you. It's our job to differentiate, and if you can't come up with a clear product positioning, then the product's going to suffer. So we have to look at all of the brands we have and be able to identify what niche they fill in the market.
Thank you. Sorry, Grant, we've got to finish up. Everybody's got deals to do. They've got to go and buy and sell hotel management companies. An industry elder a couple of years ago said, bemoaning the state of this industry, said, the only piece of innovation that I have seen in the last 10 years is the folding of the toilet paper in the hotel room. Got a little edge on it, as a criticism. That's as smart as we've got. Now, I think you've got to get a sense that we are actually stepping into a very different terrain here in terms of this industry and what's happening. So, challenging, difficult, but gee, what a fun place to be. Thank you very much. If you'd like to thank our fabulous panelists for being so frank. Thank you.